what changes are you seeing in financial risk management practices in firms? We'll give Jerry the first shot at this one. Jerry, what changes are you seeing in financial risk management practices in firms and enterprises?
Well, Conrad asked me this last night, that's something to think about. Four things jumped out to me. First is that I see that counterparty credit risk is going to be increasingly important from an end user's perspective. Second, I see a increased movement to the use of clearing services. Third, I see plain vanilla coming back in fashion. And fourth, I see increased reliance on stress testing and scenario planning. Okay, I'll go into those a little bit more. Right now, in terms of, let's say, derivative, other kind of risk management transactions, about 20% of these transactions take place on exchanges that we call boards of trades. And the issue of counterparty credit risk is not a large importance, largely because the presence of clearinghouses neutralize a lot of this risk. They employ a system of, equity ownership among a bunch of members. They employ a system of margin requirements, daily market-to-markets. But the vast amount of transactions are taking place off exchange, what we call over-the-counter, about 80% of the market. And here, counterparty credit risk is really a material consideration because, just take a swap, for example. Each party has exposure to the other party. And the ability of your counterparty to perform is really important. Now, historically, it's been the dealers who have had the upper hand in terms of, they had the higher credit ratings. And when these transactions are typically executed, they're done under a master agreement, and more often than not, you'll see the dealer imposing collateral requirements, pretty restrictive covenants, mark-to-market margin requirements on the end user. Now, this is starting to change now. Now that the end user is starting to have serious concerns regarding the dealer. Okay, a lot of the dealers, the credit ratings have been deteriorating. So that moves me into the second point. I see a lot of these OTC products now. I see they're going to be sort of maybe pushed into a clearing environment. That's going to be an increasing trend. And in fact, just yesterday, if you read your papers this morning, the Fed yesterday, the Treasury yesterday announced a major proposal, and kind of scary. Geithner, quote Geithner, they were going to force all standardized OTC derivatives contracts to be cleared through central clearinghouses. And all non-standardized derivative contracts will be required to report to trade repositories and be subject to robust standards for documentation, confirmation of trades, netting collateral, and closeout practices. But of course, as most announcements have been this day, no information was provided how they're going to eliminate standardized and non-standardized. Todd, good luck with all these power supply contracts y'all execute on a forward basis.
That is a huge concern for us, something we've been following very closely. And, really this started back early in 08 as commodities spiked. And, at that point it was sort of described as, regulating the speculative bubble in commodities. And it's sort of, over time now, it's this market transparency concept. But it's all the same legislation in different varieties. It's been sort of tackled by various committees in the House and Senate. Some of them are fairly innocuous reporting requirements. Some of them are pretty draconian in terms of clearing everything or actually trading everything through exchanges. And for a company like us, power contracts aside, just our interest rate management, it could be hugely affected. And you know, to lose some of the flexibility that we now have because everything sort of gets pushed towards standardized terms and conditions is something very concerning to us. And it's something and it's not just us. I mean, there are a lot of industry groups that are watching this very close. But we have to balance that with the credit risk you're talking about.
Well, to paraphrase Ross Perot, get ready for that huge sucking sound you're going to see in business going offshore and overseas. That's what's going to happen. Plain vanilla. I think you're going to see a movement away from a lot of these customized, highly exotic products back to more traditional plain vanilla for a variety of reasons. I think managers are becoming increasingly where they got to better understand these products. You know, you've got the manager who might who might purchase a currency option to protect against, let's say, a strengthening dollar. But he might be adverse to premiums he might have to pay. So he puts in a knockout provision that if the dollar was to strengthen to some level that couldn't possibly occur, it gets knocked out, becomes valueless. Well, what happens? The dollar strengthened beyond levels that he anticipated, and all of his protection just evaporated over his desire to save a few basis points on an option contract. But anyway, you know, for purposes of, you know, just difficulty in understanding, difficulty in valuation, and also liquidity concerns during market distress, I think there's going to be a tendency to move more to plain vanilla products moving forward. And then lastly, I just mentioned that, you know, firms and, you know, Todd, I guess your shop runs daily VAR models and so forth, but you know, a lot of these models are predicated on normal market conditions and, you know, likelihood that certain kind of movements in interest rates or prices of some sort might move 4 or 5 standard deviations is likely to only happen, you know, once every 100 years. Well, the last year we've seen several of these 100 years in just a period of a few months. So, you know, the way that firms are going to start addressing this is to do, you know, stress testing, scenario planning, where, you know, traditional volatilities are allowed to go, you know, 10 sigmas, correlation structures that have been historically stable are just going to be blown up, and just see what happens to you know, prices and losses and so forth.